Silver is exploding, not slowly, not quietly, but violently, in a way markets usually don't expect from silver. Over the past year, silver has outperformed almost every major asset. Stocks struggled, bonds disappointed, even gold moved cautiously. But silver surged, and now analysts are openly discussing a price level that once sounded absurd, $100 per ounce and beyond. But this is not just a story about price charts or investor speculation. This is a story about supply chains breaking, political instability, and one country that quietly sits at the heart of the global metal system. That country is Chile. Chile is not just another mining nation. It is one of the most important suppliers of the metals that power the modern world: copper, lithium, and critically, silver as a byproduct. And right now, Chile is facing a crisis that most investors are ignoring. Because when silver spikes like this, it's never about silver alone. It's about energy, technology, geopolitics, and control. So today, we're going to break down why silver demand is structurally rising, how Chile's crisis threatens global supply, why silver behaves differently from gold, and what this means for markets, governments, and investors. Even if you don't own a single ounce of silver, this is not hype. This is the anatomy of a potential supply shock. Silver is often treated like gold's smaller, more volatile cousin. But economically, silver plays a completely different role. Gold is monetary trust. Silver is industrial necessity. Silver is used in solar panels, electric vehicles, data centers, semiconductors, military electronics, medical equipment, high-precision sensors. It is the best electrical conductor on Earth. And unlike gold, when silver prices rise, industries cannot stop buying it. They don't wait. They don't substitute easily. This makes silver an inelastic commodity. Demand stays strong even when prices rise. That is the first reason silver moves in sudden, explosive phases instead of smooth cycles. The world is undergoing three simultaneous transitions: energy transition, digitalization, militarization of technology. All three consume massive amounts of silver. Solar energy alone is consuming more silver each year than at any point in history. Electric vehicles require far more silver than internal combustion cars. AI data centers require ultra-reliable electrical components, many of which rely on silver. This demand is policy-driven, not optional. Governments are not asking industries whether they want to electrify, they are mandating it. That means silver demand is not cyclical anymore. It is structural. Here is the critical problem. Silver is rarely mined on its own. Roughly 70 to 80% of global silver production comes as a byproduct of mining. Copper, lead, zinc, that means higher silver prices do not automatically create more supply. To increase silver output, the world must mine more copper, mine more base metals, build more refineries, secure more water and energy. This is slow, capital-intensive, and politically sensitive. Which brings us to Chile. Chile is one of the most resource-critical countries in the world. It is the world's largest copper producer, a key lithium supplier, a major contributor to silver through byproduct mining. If Chile sneezes, global supply chains catch a cold. And right now, Chile is not stable. Chile's crisis is not a single event. It is a stacking risk. It includes political instability, constitutional uncertainty, rising mining royalties, environmental restrictions, water shortages, labor unrest. Mining projects are being delayed. Expansion plans are being revised. Foreign investment is becoming cautious. For silver, this matters enormously, because when copper production slows or becomes more expensive, silver supply tightens automatically. And unlike oil or gas, there are no strategic silver reserves that can easily stabilize markets. This supply stress is happening exactly when demand is accelerating. That is the most dangerous combination in commodity markets. Rising demand, fragile supply, this is how price shocks are born. And silver has a long history of doing exactly this. Flat for years, then sudden vertical moves. Not because of speculation, but because physical availability breaks down. Historically, silver does not move gradually. It compresses, then it explodes. In the late 1970s, silver went from under $10 to nearly $50 in a short window. Adjusted for inflation, that level is far above today's prices. What makes this cycle different is industrial dependency is higher, supply is more centralized, energy and geopolitical risks are higher. Once industries compete with investors for physical metal, prices can overshoot violently. That is how markets ration scarcity. This story is not just about one metal or one country. It's about a world where supply chains are no longer reliable. Governments weaponize resources, energy transition collides with political reality. Silver sits at the intersection of technology, energy, military power, industrial survival. And Chile's crisis is a reminder that modern economies are fragile, even when demand looks unstoppable. This is not investment advice. But structurally, silver is shifting from a forgotten precious metal to a strategic industrial input. Markets tend to price this late, not early. By the time consensus agrees, volatility is already extreme. Silver ETFs and physical silver purchases are rising again. Retail and institutional investors are starting to hedge against inflation and instability. Silver is seen as both an inflation hedge and an industrial growth asset. This dual role makes it uniquely attractive. Once investment demand accelerates, price moves can become violent. Even when inflation appears to slow, underlying pressures remain. Debt levels across the world are historically high. Central banks are trapped between inflation and recession. Precious metals benefit in this environment. Silver often lags gold, then suddenly catches up aggressively. Historically, the gold-to-silver ratio fluctuates within ranges. At extreme levels, silver has been deeply undervalued. Current ratios suggest silver is still cheap relative to gold. When this ratio corrects, silver tends to outperform sharply. This is one of the strongest long-term bullish indicators. Most silver trading happens on paper markets. Physical silver availability is far tighter than paper prices suggest. If physical demand spikes, paper pricing mechanisms can break. This disconnect has caused sudden price explosions in the past. The risk of a supply squeeze is real. While central banks don't buy silver like gold, they monitor commodity inflation. Rising silver prices signal industrial stress and supply breakdowns. This feeds into broader inflation expectations. Markets react quickly when these signals align. Silver often moves before policymakers respond. Global trade is fragmenting. Countries are prioritizing domestic resources and strategic materials. Silver, due to its industrial importance, is becoming more strategic. Supply disruptions are more likely in this environment. Geopolitics adds fuel to already tight markets. A decade ago, $100 silver sounded unrealistic. Today, under the right conditions, it's mathematically plausible. Inflation-adjusted historical highs already support this range. Add supply shortages and demand growth, and the case strengthens. This doesn't require hype, only continuation of current trends. A major mining disruption in Chile. A surge in solar or EV demand. A physical silver shortage in ETFs or vaults. A financial crisis pushing investors into hard assets. Any one of these could act as the spark. Silver is highly volatile. Price swings can be brutal in both directions. Leverage amplifies losses as much as gains. Timing matters more in silver than in gold. This is not a set-and-forget asset. Silver is highly volatile. Price swings can be brutal in both directions. Leverage amplifies losses as much as gains. timing matters more in silver than in gold. This is not a set-and-forget asset. Many analysts believe we are entering a new commodity supercycle. Energy transition, infrastructure rebuilding, and geopolitical shifts support this view. Silver sits at the intersection of all these forces. Its importance is increasing, not fading. That makes silver one of the most interesting metals of the decade. Silver's story is no longer about speculation, it's about structure. Chile's crisis, global supply stagnation, and rising industrial demand are reshaping the market. Prices may not move in a straight line, but the pressure is building. Those who understand silver early tend to benefit the most. The real question is not if silver moves, but when.